So here we are in Module Group B, Government in the Marketplace. In previous editions, this was a standalone chapter. I'm not sure what they mean by moving it to a module instead of a chapter. But Module 5 of Group B, and the learning objective. Okay, Module 5 looks at market power, and the learning objective is to explain why market power reduces social welfare and identify two types of government policies aimed at reducing deadweight loss. Okay, so let's just review the idea of market power. Okay, in general, the best market outcome is when consumer surplus and producer surplus is maximized. Okay, we call that the socially efficient quantity and price. Okay, and that is when price equals marginal cost. Okay, and that happens in this perfectly competitive ideal market structure that we've talked about. So when a firm reduces the output that it sells less than the socially efficient level, and it raises its price above marginal cost, then we say that firm has some market power. Okay, and if government can intervene in that market, they can increase efficiency. They can lead to a more efficient outcome. Okay, and the graphical analysis looks like this. We've got demand and marginal cost, which is the supply curve, and when marginal revenue, okay, monopolistically competitive firms, oligopolistically competitive firms, and monopolies all have a marginal revenue curve that lies below demand, so they can, when they set marginal revenue equal to marginal cost to determine output, then that raises the price above marginal cost. So the shaded in area would be the consumer surplus and producer surplus generated in a competitive market. And then, so because output is not at point C, output is artificially constrained to QM, then the darker shaded in area is the deadweight loss. And that's what we're trying to avoid with antitrust policy. Okay, and so the purpose of antitrust policy is to eliminate that deadweight loss. And antitrust policy makes it illegal for business firms and managers to engage in anti-competitive activities. And the foundation of antitrust policy is the Sherman Act. And this came out in 1890. Sherman Antitrust Act. A trust back in the old days was a group of big business firms that would literally get together and set prices and then trust each other not to cheat on that cooperative agreement. Okay, so I'm not going to read you Section 1 and Section 2 of the Sherman Antitrust Act. Okay, these are all legal details associated with trying to prevent anti-competitive practices in markets. Okay, another important part of antitrust policy is the Clayton and Robinson-Patman Acts. Okay, these focus on price discrimination, which we'll talk about in Chapter 3. Okay, when price discrimination substantially lessens competition, then that's illegal. But there's certain situations where price discrimination can be permitted. And then the Clayton Act makes illegal a bunch of other business practices: kickbacks, rebates, exclusive dealings, price fixing. Okay, mergers that lessen competition. And then I'm not sure how to pronounce this, but maybe the Keller-Kefauver Act. It strengthened the Clayton Act. Okay, with a focus on mergers and acquisitions. This was in 1950. Okay, and then merger guidelines were updated in 1982, 84, revised in 92, 97, and 2010. Okay, and these guidelines were based on the HHI that we talked about in Chapter 7. Okay, so these are the merger guidelines. Okay, a merger that increases the HHI by less than 100 or leads to an unconcentrated market. Okay, that's defined as an HHI of less than 1,500. Okay, and those mergers are typically permitted by the federal government. Okay, markets, according to these merger guidelines, markets are moderately concentrated if the HHI is between 1,500 and 2,500. Okay, if you are thinking about a merger, your HHI is in this range, and the merger would raise the HHI by more than 100 points. Okay, that gets I think it's the Justice Department interested in your merger. They might be thinking they should disallow it. Okay, markets are considered highly concentrated if the post-merger HHI is greater than 2,500. Okay, especially if the HHI would increase from 100, 100 or 200 points. And if any merger increases the HHI by more than 200 points and leads to a highly concentrated market, again above 2,500, that's a definite merger that would increase market power and would get a good strong look from the federal government. So the Hart-Scott-Rodino Antitrust Improvement Act of 1976 requires that two business firms that plan to merge have to tell the Department of Justice and the Federal Trade Commission of their intent. If the dollar value of the combined firm is over $94 million. So these are big firm mergers that the federal government is interested in. Okay, and then those firms have to wait, after notification, those firms have to wait 30 days before they can complete the merger transaction. And DOJ and FTC can say, wait a second, we want to look at this a little bit more closely. And so they can ask for another waiting period. And then the DOJ and the FTC, if they don't like what they see, if the merger would lead to an HHI above 2,500, then they can file a complaint to block the merger. But if everything looks good, they can permit the merger.